Good afternoon, everyone, and thank you for joining our session today, where we're going to cover some financial planning tips on maximising your wealth in the 2024-2025 tax year. We'll start by recapping the 2024 budget, understanding the changes in tax rules before looking at the best ways to maximise tax-efficient investment strategies for this new tax year. I'm going to run through a case study on how you can leverage pension contributions to boost retirement savings through smart structuring. And then finally, we'll look at how to choose the right risk level to meet your investment and saving goals going forwards, and how to navigate economic, geopolitical challenges and market volatility in the year ahead. Thank you to everyone who sent in questions beforehand. I have done my best to answer them in the content today, but for any more specific questions, either sent in beforehand or if you have any that come up today relating to your own circumstances that you'd like to cover in more detail, then please do email advice@netwealth.com and a member of my team will be happy to help. So first, let's kick off with a recap of the recent budget to aid in how we can understand and adapt to the changes in tax legislation and make sure we're making the most of our allowances going forward. One of the biggest budget announcements, as I'm sure we're all aware, was that cut in national insurance from 10% to 8%. It's estimated that this is going to impact 27 million workers from this month, so from April, saving them up to £450 a year. Other announcements included reducing the higher rate of CGT, so capital gains tax, on property from 28% down to 24%, and abolishing the resident non-domiciled tax status. And finally, there was the introduction of a British ISA. The British ISA was designed to encourage investment into the UK businesses and will add an extra £5,000 to ISA allowances each year, meaning now that overall ISA wrapper allowance is £25,000 per individual rather than £20,000. And we had some questions in on the British ISA beforehand and what might be happening with it, when it might be implemented. It's not yet clear when this is going to be launched and what the exact rules will be relating to investment in UK businesses and firms. So we are awaiting more details to come on this. The Treasury has issued a consultation running from the 6th of June, where they're going to gather feedback from relevant parties. So we will likely know more in due course. And obviously, as and when we receive more information on the specifics to consider here, we will, of course, revert. So moving on from that quick budget recap, let's take a closer look at the tax rates and allowances for 2024-25 to be aware of. The changes made to income tax in the 2023 budget remain in place for the 2024-25 tax year. And I put them in this table here on the left-hand side. So to run through them, the freezing of the personal allowance, otherwise known as a stealth tax, bringing more assets into tax rate, and reduced additional rate tax threshold to the £125,140 remain the same, as do the tax rates. The things that have changed from 2023-24 into 2024-25 are capital gains tax and dividend allowances. So the capital gains tax annual allowance is now £3,000 and the dividend allowance is now £500. So that's halved from the 2023-24 levels and something to definitely be aware of. So those are the relevant rule changes. So let's now look at how to best maximise these in tax-efficient investment strategies, starting with ISAs. So everyone has a £20,000 ISA allowance each tax year, and it goes without saying it remains one of the best ways to save, with the returns inside the wrapper free of tax and tax-free withdrawals. These savings and investments can be used for short-term financial needs or longer-term financial goals and objectives, things like saving up for your first home deposit or supporting future retirement income much later in life. So obviously the tax year has just reset. So if you have some fund surplus for investing and you haven't yet used all of your £20,000 ISA allowance for the 24-25 tax year, it's definitely worth considering and doing so. I mentioned earlier the introduction by the Chancellor of the British ISA. As I said, more details and further clarity are needed here, but theoretically, this will increase the amount of tax-free savings from £20,000 per individual per tax year to £25,000 per individual per tax year. There are also different types of ISAs. So the lifetime ISA, you can allocate £4,000 only of your £20,000 overall allowance to the lifetime ISA, and it entitles you to a 25% government bonus. But there are conditions that need to be met to get that bonus. That includes only accessing and using the funds to buy a first-time home within a certain price range, or accessing the funds at age 60 to encourage retirement saving. You also have a £9,000 JISA allowance, so a junior ISA per child that can be utilised in wider family financial planning. But JISAs do come with restricted access before the child turns 18, when it legally then turns into an ISA in their name. There is some nuance that advisors can help with here. So including the point towards the bottom of the page here about using children's cash ISA allowances of £20,000 at 16 and 17, in addition to the £9,000 junior ISA, meaning that for 2 tax years, you can save £29,000 for your child per year before it then becomes an ISA in their own name. So really sort of bulk it up before they then turn 18 and it becomes their ISA. We also had a question come in regarding ISAs and whether you need to keep the same provider throughout. So every year you can save £20,000 in one account or split this allowance across multiple accounts. And from this tax year, you can open and pay into multiple ISAs of the same type in the same tax year. Whereas previously, for example, you couldn't pay into 2 stocks and shares ISAs with different providers in the same tax year. You had to pick one or the other. The subscription rules have simplified from this tax year onwards. This is except for the lifetime ISA, where, as I mentioned, you can only pay into one per year and only £4,000 of your overall allowance. Moving away from ISAs onto capital gains tax and how to use your allowances here in investment strategies in the most tax efficient way. As I mentioned earlier, for this tax year, the allowance is £3,000 for capital gains tax. So you can crystallise up to £3,000 of gains before paying 10% CGT if you fall within the basic band, or 20% for anything above. Also worth bearing in mind that you can carry forward losses from previous tax years to reduce the value of the gain and so reduce tax paid. You can't carry forward gains. It's sort of a use it or lose it allowance, but you can carry forward losses. So it's a sensible move to utilise your CGT allowance annually. And this is a service that we do offer at Netwealth for clients to opt into for no extra cost. So utilising your allowance each year increases the base cost of your portfolio and so reduces the value of cumulative gains year on year, reducing a potential tax bill in the future if you just left the account alone and let the gains build up and did not harvest them each year. So capital gains tax allowances are often not considered as much as ISAs or pensions because it feels a bit more complicated. But as I mentioned, it is a service that we offer for our clients in Netwealth, where all you would have to do is opt in, let us know the gains or losses you're looking to target for your account, and we will do the rest. Now to pensions. So with increased annual allowance in 2023 budget and carry forward, pensions can be a very tax efficient investment strategy, either to lower your tax now and boost your retirement savings. This tax year, the pension annual allowance is £60,000 gross. So you can also utilise any relevant carry forward if you have the relevant earnings, of course, from the 3 previous tax years. Although it's worth highlighting at this point, the maximum carry forward for the years prior to the 2023-24 increase in the annual allowance will be the old annual allowance of £40,000. If you're unsure of the amount of carry forward you have or relevant earnings, Netwealth do offer pension contribution advice pieces where we work out the exact allowance and amount you can contribute in a given tax year for you, taking into consideration unused allowances from previous tax years, relevant earnings, and giving you the total amount that you can contribute. So this can be particularly useful for those paying higher and additional rate tax, as pension contributions can be a beneficial way to claim the additional 20-25% tax relief on your tax return. Tax relief is granted up to the value of relevant earnings, and we have 2 different examples here at the bottom with 2 different sets of relevant earnings that I will run through. So in the first example, if you earn £30,000, then the maximum you can contribute and receive tax relief on is £30,000 gross, which works out at £24,000 net contribution to then be topped up by the government. In the second example, if you earn £100,000 and have relevant carry forward allowances from the previous 3 tax years, then you could contribute the full £100,000 gross, which is actually £80,000 net, that the government will top up by the basic rate, and you can claim any relevant higher or additional tax relief back in your self-assessment. Now, depending on the amount you earn, that £60,000 gross annual allowance may be subject to tapering. Tapering comes into effect if your adjusted income is between £260,000 and £360,000 and reduces your annual allowance by £1 for every £2 your adjusted income is over £260,000. So this could, in the most sort of extreme example, could reduce the £60,000 annual allowance by a maximum of £50,000, leaving the most you can contribute into your pension at £10,000 if you're subject to the maximum level of tapering. Adjusted income is worked out with the equation at the bottom of the slide here and constitutes salary, bonus, interest and dividends and your employer's pension contributions. As I mentioned earlier, pension annual allowances and tapering can become quite complicated and cumbersome to sit through and work out yourself on top of everything else going on. And it's definitely something that we help clients with through advice work. So if you're interested in the clarity and certainty that comes from taking a pension contributions advice piece, even if you're not a client of Netwealth, do get in touch because this is something that we can help both clients and non-clients with for a £400 cost. So now that we have run through the relevant rules on pension contributions, I'm going to run through a quick case study on how to leverage these pension contributions to boost your retirement savings. So on this slide, we're considering a client who's 50 years old, has a surplus £50,000 available for investment this tax year. This could be from inheritance, perhaps from the sale of a property, or a particularly good year of savings and bonus. They've decided to put that full £50,000 that they have available into a general investment account, so a non-tax wrapped account. Perhaps they've already used their ISA allowance this year and are not sure about their available pension allowance because it happens automatically with their employer, straight from their salary, of putting it into a GIA and leaving it alone until they then want the funds at age 65 when they have decided to retire. So this client earns £65,000 from their employment, and so these tax rates are taken into consideration with the projection. As I mentioned, a general investment account is not a tax wrapper in the same way that an ISA and a pension are, so we have to take this into consideration. So we can see here that it's not a bad outcome in investing it for 15 years and coming back to it. The £50,000 has grown to around £114,000, and it's a nice addition of funds to the pension and other savings that the client may have built up in ISAs or other investment accounts throughout their working life, and that they can now draw on in retirement. So it's not a bad strategy. The client has recognized the benefits of investing over longer timeframes of 15 years and put the funds to work rather than leaving them in cash, and now has grown that pot to just over £114,000, preserving the real value of their capital over this time. And as I said, has another pot to dip into alongside their pension and ISAs at their chosen retirement date that they've built up through their time working. Now let's look at a different client who has perhaps utilized financial advisors guidance or taken some regulated advice work and has decided to structure this £50,000 investment more consciously. So the inputs into this projection are the exact same. The client's also 50 years old. The investment strategy and the risk taken with that £50,000 is exactly the same. So we're controlling for performance. The £65,000 income is exactly the same. And they're also retiring in 15 years' time. The only difference here is the client has chosen to put £18,000 of that £50,000 available for investment into a stocks and shares ISA straight away. And then they've put the remaining £32,000 of the £50,000 that they had available for investment into a pension as a contribution using their available annual allowance. So first of all, with the basic rate tax 20% top up that the government give to the pension contribution of £32,000 before the investments have had time to grow, Through smart structuring, the client has £58,000 invested on day one instead of £50,000. Even though they themselves have only contributed £50,000, that top up from the government on day one, you've got an extra £8,000 invested. So this shows the benefits of pension contributions and the tax relief you get on the way in, grossing up your total initial investment amount. Now, secondly, because the investments are in tax wrappers of ISAs and pensions instead of taxable accounts, like the general investment account with the first client, despite being invested in the exact same way, you're over £25,000 better off after 15 years. So that's half of the amount that you initially put away for investment to start with that you've saved from the benefits of tax wrappers alone. And that can make a real difference. That's either a higher amount of retirement income or your retirement income lasting for more years. Therefore, it makes sense to utilize your tax wrappers where you can. And the final part here on smart structuring, if inheritance tax is a consideration for you, as it is for most of us, in the first example, upon the client's death, any assets remaining are still in the general investment account, and so inside of your estate for inheritance tax purposes. Whereas for the second client, the vast majority of their assets, if not all, at death, are going to be in their pension. And that's sheltered from inheritance tax, as a pension is not considered part of your estate. We did have a question sent in on inheritance tax and pensions. So to confirm, pensions are outside of your estate for inheritance tax purposes and will pass on to your beneficiaries as specified in your expression of wish, whether this be a spouse, a child, or into a trust. The expression of wish is important to have in place for your pension, so it can go exactly where you want it to go and to the people that you want it to go to. So do check that you have this in place with your current pension provider and listed with your desired beneficiaries. So there's some real smart structuring points here around pensions, particularly that can help both boost the initial amount of retirement savings, turning that £50,000 into 58 at the beginning, and also growing it by much more, being in a tax wrapper throughout the same investment time period, and also helping with inheritance tax. So advisors at Netwealth help clients with things like this and smart structuring, either through guidance and answering questions and just being a sounding board for clients, or through formal advice work, where we would look at your overall asset base and work out the most tax efficient strategy and structuring for you going forwards. So if you are interested in finding out more about how Netwealth can help you specifically on things like this around structuring, then do contact us at advice@netwealth.com. So for a quick interim summary on tax efficient investment strategies for the 24-25 tax year to consider. ISA allowances. So they're still one of the best ways to shelter your assets from tax. And you can utilize family allowances of £20,000 for adults and £9,000 for children, and potentially even an extra £5,000 in the British ISA, looking forward to future tax years. But as I said, we're still waiting on more details there. Capital gains tax allowances. Use your £3,000 personal allowance, rebase your book costs going forwards on an annual basis to reduce the potential cumulative tax bill building up. And finally, pension contributions. So it may make sense to do an increased pension contribution if you're impacted by additional rate threshold reduction. Check how much annual allowance you have and consider carry forward allowances from previous tax years if you have the relevant earnings, and smart structuring, either through talking to an advisor or on your own. Make conscious investment structuring decisions to maximize your investments in a tax efficient manner where you can. Now, let's move on to investment strategies themselves and how to best decide what level of risk you should be taking in your portfolios. To start with, being invested in the first place versus holding cash is important. So we understand that with interest rate increases that we saw throughout 2022 and 2023, cash rates with banks were very appealing, perhaps offering 4 or 5% fixed term deposit rates. And whilst we definitely advocate for keeping cash reserves and balances that you feel comfortable with, particularly in retirement and the lead up to retirement, the impact of holding too much cash with inflation eroding the value of that cash is still important to consider. And I think the graph on this page demonstrates this nicely. So here we have £100,000 held as cash after inflation or invested in line with Netwealth's balanced risk level 4 portfolio. The time period chosen here is important as it includes the 2008 global financial crisis. So you can see during that time on the left-hand side of the chart, holding cash was a better option as markets fell significantly, shown by that lighter blue line. However, when you're looking over that longer term time horizon, markets recovered and quickly surpassed that cash. By the end of 2023, you're over £400,000 better off when investing as compared with leaving it in cash. After inflation, the cash pot has fallen in value, but the investment pot has increased in value. So investing to keep pace with inflation and preserve the real value of your cash is important. Particularly at the moment, markets are forward pricing, they're forward looking, and they're already pricing in interest rate decreases this year. When and how quickly those rates will fall is yet to be seen, but there is some market consensus that rates in the UK have peaked. And so although you may have been able to get 4 or 5% with your bank on the fixed deposit before, this may be short-lived now, especially when looking forward and locking it in for 6 months, 12 months. And so the benefits of investing to keep pace with inflation are definitely sort of coming back to the fore. So what level of risk should you be taking? At Netwealth, our portfolio management team have designed 7 different risk level portfolios, one being lower risk and shown by the bottom left-hand side of the graph here, just above cash deposits, and 7 being higher risk at the top right. So this graph shows something I'm sure we're all aware of, that the more risk you take, the higher the potential return. But picking the right level that you're comfortable with is still important. Time horizon is very important when thinking about risk. So the graph here shows the Netwealth risk levels 2, 4, and 7. So low, balanced, and higher risk portfolios, and the percentage of times you would have lost money using 25 years worth of market data over the different time horizons across the bottom there. So you can see that when looking at the percentage of times you would have lost money over shorter time horizons, so 1 month to 1 year, there's a chance of losing money across all the risk levels, less so in the lower risk levels 2 and 4 as compared to 7. However, when you look over to the right-hand side and we're looking over 5 and 10-year time horizons, the percentage of times that you would have lost money dramatically drops off over those longer time frames, even in high equity-based portfolios like our risk level 7. Therefore, the benefits of investing over that medium to long term really come into play, where you're able to sit through the interim bouts of volatility that we definitely do see in investment portfolios. But still, even if you had a time horizon of 10 or more years before you need the funds, perhaps it's a retirement pot that you aren't able to touch until age 55 at the youngest anyway, you may not appreciate the volatility associated with the higher risk levels in order to achieve those higher returns. And so despite having what we call the ability to take risk with a long time horizon, you may not have the willingness. So willingness and appetite for risk are also very important when choosing your risk level. And this is something that my team, the advisory team at Netwealth here, often help clients with, aiding their decision making on where they sit on the risk spectrum to best meet their goals, considering time horizon, but also their willingness to take risk. Now, 2024, we're already a couple of months in, but it's set to be a busy and uncertain year with geopolitical risks continuing in the Middle East and Eastern Europe, and economic and political risks, including UK elections, US elections, both set to take place in the later half of this year. When will central banks be bringing interest rates down? This can all be hard to navigate and account for. So let's look now at ways to help with that in the year ahead. At Netwealth, we focus on controlling the controllables. So on the left-hand side, you can see the things we can't control. So these include market performance, inflation, and how long we live for. We can't control economic events that cause market volatility or the levels of inflation that we're currently seeing. So instead, we focus on the right-hand side here and what we can control. So we can control spending time in the market rather than trying to call ups and downs in times of volatility. We can control how diversified our portfolios are. we can control how we structure our assets and use all available tax allowances where possible. And we've covered a lot of that in the beginning half of the session today. And we can also control what fees we pay. So now I'm going to run through how to look at controlling the things we can control to lead to the best outcomes in times of economic change and market volatility. Firstly, that point on timing the market. So markets can be volatile, as shown by the graph here. They don't move upwards linearly, but they do trend upwards over time. And staying invested through volatile times can really improve investment outcomes. So on this graph, we've taken the returns of the S&P 500, so the US market index, from 1987 until the end of 2023. And if you'd been invested for that entire period, your total returns in dollars would be over 4,000%. However, if you missed only the top 10 trading days over this 35-year period because you're out of the market, you're trying to call tops and bottoms, you would only be up 1,800%. And this is a stark difference in returns for just 10 days missed in an entire 35-year period. And so I feel really highlights the importance of staying invested even through volatile times, as markets do dip, as we can see here, but often periods of poor performance are followed sharply by periods of stellar performance. And this graph shows the consequences of being out of the market in that time. So pick the right level of risk for yourself at the beginning of your investment time frame. Utilize access to advisors and guidance and let them be a sounding board for your decisions. Stay invested as best you can throughout your investment time horizon, controlling the controllables and spending time in the market rather than trying to time the market in times of volatility. Another thing we can control is diversification. So on this slide here, I've taken a snapshot showing the current asset allocation of Netwealth's 7 different risk levels on the top, and underneath that we have the currency allocations of the 7 different risk levels too. Now, the portfolio management team here choose our allocations for each risk level, both the asset class and the currency very actively, and they do a lot of due diligence around exact exposures for given risk appetites to ensure that we've got the adequate levels of diversification. So diversification helps in times of market stress, as you've then got multiple drivers of performance in portfolios. So different asset classes have different correlations to each other. So if we look for a negative correlation, for example, and we take fixed income and equity markets. When equity markets are performing poorly, fixed income markets tend to perform better, and so they act as a protective component of portfolios, compensating for poor performance in other parts of the portfolio. This is obviously a simplified example of the powers of diversification, and it doesn't necessarily work exactly that way. As we all know, in 2022, both equity markets and fixed income markets sold off together. So they didn't feel like there was protective layers in the portfolios, and markets were hurt and portfolios were hurt. And it was a tough year for all sort of investment managers around that time, because, as I said, they both sort of sold off together as central banks around the world were hiking interest rates to combat the post-pandemic inflation spirals that we found ourselves in. So the correlations between asset classes aren't perfect and don't always happen in the ways in which we envision or plan for, but diversifying your portfolio does help to smooth returns by having multiple drivers of performance, and it is something that's in our control, whereas market ups and downs aren't. So having a well-diversified portfolio can help in times of market uncertainty and volatility. And if you want more information on the asset classes and the allocations that the team have across the 7 Netwealth risk levels, then do get in touch. We'd be happy to share this information with you. But as you can see, sort of on a sliding scale, from the left-hand side or on the low-risk portfolios to the high-risk portfolios, the allocations to equity markets in the greens vary, and we also have different exposures to different geographical regions in there as well. And finally, so we've already covered today how to maximize tax wrappers earlier in the session. So the last controllable that I'm going to cover here is low fees. So how much we pay for fees for a given investment service is important and shown nicely in this slide here. At Netwealth, we focus on lower fees compared to the industry standard for clients, but without a compromise on the wealth management service that we provide to help clients achieve sort of better net returns. The graph here shows £250,000 investment pot. We've assumed the same average annual return between the two portfolios. They're exactly the same amount of 5%. So the only difference here shown between the two lines is the all-in annual fee of 0.9% at Netwealth versus 1.65% at a more traditional wealth manager that's charged on the same amount. So this 0.9% net wealth fee includes discretionary wealth management by the portfolio management team here, in line with the risk level that you've chosen, custody and administration of your assets, as well as any underlying fund costs that are associated with our portfolios, because they ultimately get passed on to clients. So we like to be as transparent and upfront about those as possible. So it is an all-in fee. You can see the impact of fees here over a 20-year time horizon and see that keeping performance and growth of the portfolio is the same, but looking at fee difference alone, the 0.75% fee saving that you would have between the two providers leaves you over £75,000 better off after 20 years. And this is on fee savings alone rather than performance. So controlling what we're paying in fees is really important to our net returns and the potential size of our nest eggs when we come to need them. And the larger that nest egg is, the more income perhaps you can take when you look at retiring or drawing from these pots, or the longer that income will last for. So it is really important to control what we can and control fees. Now, I just mentioned performance and how that was controlled for in showing that fee savings alone on the previous slide. But just to give you a quick snapshot on Netwealth performance up to the end of Q1 this year, so the end of March, because I do appreciate clients want to see good performance as well as competitive fees for their investments. So it goes both ways. Performance is obviously important, both for our existing clients and any prospective clients considering a move. And we do have a full performance pack available. If you'd like this information, we'd be happy to share it with you if you email us. But this slide here shows Netwealth's performance of our 7 different risk levels from our inception in May 2016 to the end of March this year. So Netwealth's portfolios are shown in the blue bars, and we benchmark against ARC in the grey. So ARC are asset risk consultants, and they're a third party who amalgamate the performance data of over 100 wealth managers in the UK to produce a monthly peer group average for a given level of risk. So we benchmark our risk level 7 against the ARC equity risk and our risk level 3 against the ARC cautious, etc., etc. And as you can see, we're pleased to report outperformance across the board. And this is in part due to the team's positioning, their strategic and cyclical asset allocations, but also in part due to the positive tailwind our portfolios get with lower fees. So benchmarking is important, and we benchmark against ARC because it really, with taking the data of over 100 UK wealth managers, it's really meant to give an idea of what you can expect to achieve for a given level of risk as a private client in the UK wealth management space. As I said, if you want more details of our full monthly performance pack, do get in touch, or if you'd like to speak to an advisor to look at your current portfolio positioning, where you are, your current fees, your current performance, to have a comparison, then do email us as well. So to finish up, I've mentioned a few times during the webinar today how Netwealth can help in both guidance and advice, and I'm going to cover these services quickly in a bit more detail. But if you would like to find out more on how it can apply to your specific situation, as I said, do get in touch at advice@netwealth.com. So firstly, at the top of the slide here is an overview of Netwealth's investment management fees. There was a question sent in on the fees we charge, and so I included this table, but I won't spend too much time reading through this, as it can be found on the website. If you'd like to discuss fees specifically in relation where you are now and what it might look like in Netwealth, then you can get in touch with us directly, and we'd be very happy to help there. I'll focus instead on the costs of financial advice here at the bottom. So we have 2 different advice services in Netwealth, allowing clients the flexibility to pay for advice either on an ongoing basis or take one-off pieces if ongoing advice isn't suitable, or you only need sort of an initial piece to help get you set up, or something on something more specific. The one-off advice work can cover all things financial planning, reviewing current arrangements, and recommending how to best invest for the future, whether that be efficient structuring, income analysis, retirement planning, some bespoke cash flow modeling. The cost of this service is £200 per hour, and the price is always agreed with the client prior to doing any work, so you won't be lumped with an unexpected bill at the end. Or the ongoing advice option is 0.35% per annum on the value of your account, in addition to the investment management fees that we've listed at the top. So it's worth reiterating as well, if you would like a one-off advice piece, you don't actually need to be an investment management client of Netwealth or have your portfolios with Netwealth. And we do also have specific one-off advice packages as well for common singular financial planning points. And these are pension contributions, as I mentioned earlier. So working that out for you with relevant tapering, relevant earnings, carry forward, and annual allowance. And the cost of that is £400. Or we have drawdown retirement one-off pieces, as this is often quite common with clients or prospective clients. You've built up these pots your whole life, and you then want to look at how to draw from them in the most tax efficient way. You've got a different pots everywhere, and does it make sense to consolidate and things like that. If full-blown financial advice that we've just spoken about isn't required for your situation, but you would benefit from a check-in with a qualified financial advisor, at Netwealth we have recently launched our financial planning MOT guidance service. This costs £400 for an individual or £600 for a couple, and it gives you a sense check on your overall asset allocation, tax efficiency, and financial goals. Again, you don't need to be an investment management client of Netwealth to take advantage of this service. And if you would like to find out more on the MOT, then do get in touch. It can sometimes help for peace of mind to get a sense check on, I think I know I'm doing all the right things, but it's a small cost to pay for the peace of mind in going forwards. So now to summarize what we've covered today. When looking to maximize your wealth, utilize your personal tax allowances where possible, whether that be pensions, as we mentioned, ISAs, or capital gains tax, the lesser thought of allowance that you can make use of. I appreciate it's been slashed and it feels quite small, but it definitely is worth looking at. Think about how you're structuring your assets and whether you're being the most tax efficient, and speak to a financial advisor if you need some help here, either through guidance or advice. And look at the level of risk you're currently taking in your portfolios, and control the controllables in uncertain times. So namely fees, diversification in your portfolios, and spending time in the market rather than trying to time it. And finally, get financial advice or guidance where applicable to give yourself and your savings the best chance of meeting your goals in the future. So thank you for joining me today. I hope you found the session useful. And if there's anything you'd like to cover further with one of the advisors at Netwealth, do get in touch at advice@netwealth.com, and we would be very happy to help. I hope you all have a great rest of your day.